Oracle just shocked Wall Street. Not because the company had a normal good quarter, not because the stock went up a little, but because Oracle delivered an earnings report that exposed one of the biggest battles happening in the market right now. Who is really winning the AI money race, and who is quietly burning cash trying to keep up? Because here's what just happened. Oracle beat expectations. The stock surged after hours. The company raised its long-term revenue target to $90 billion. And yet, behind all of that good news, there's a much bigger story most people are missing. Oracle is spending money at a terrifying pace. Its stock had already been crushed. There were reports about canceled AI expansion plans. There were reports about job cuts. And now investors are stuck asking one huge question. Is Oracle building the future of AI infrastructure, or setting itself up for one of the most expensive mistakes in tech? And trust me, by the end of this breakdown, you'll understand why this is no longer just an Oracle story. This is about the future of AI, cloud power, data centers, and the brutal amount of money big tech is willing to spend just to stay alive in the next phase of the market. So let's break it down carefully, because the headline sounds bullish, but the real story is much deeper. Let's start with the raw numbers. Oracle reported third-quarter earnings, and the company came in above Wall Street expectations on both profit and revenue. Oracle posted $1.79 in earnings per share and $17.19 billion in revenue. Analysts were expecting $1.7 in earnings per share and $16.9 billion in revenue. So yes, Oracle beat estimates. And in this market, that matters. Because when a company is under pressure and expectations are shaky, a beat does more than just look good on paper. It tells investors that the company may still have momentum even while the market is doubting it. And that's exactly why the stock reacted so strongly. Shares jumped as much as 8% after the report. But that is only the surface-level story, because Oracle wasn't heading into this earnings release from a position of strength. It was coming in bruised. The stock had fallen hard in recent months. After reaching a high of $345.72 back in September, Oracle had dropped to around $149 by Tuesday afternoon before the earnings release. That means the stock was down 54% over the last 6 months and 23% since the start of the year. That's not a small pullback. That is a brutal collapse. So when Oracle posted better than expected numbers, the market didn't just see a beat. It saw a company trying to prove that the sell-off may have gone too far. And this is where things start getting interesting. Because if this were just a simple earnings beat, we wouldn't be talking about it this much. What really changed the mood was Oracle's decision to raise its 2027 revenue outlook to $90 billion. That is the kind of number that instantly grabs investor attention, because long-term guidance is not just about the next quarter. It's about what management believes the company can become over the next several years. When a company raises a long-term target in the middle of market skepticism, it is sending a message. It is saying, we know what we are building, we believe demand is coming, and we are confident enough to make that prediction public. That's the part that made Wall Street stop and pay attention. But there's another layer to this story, and that layer is cloud. If you want to understand why Oracle still matters in this AI era, you have to understand what the company is trying to become. Oracle doesn't want to be seen as just an old enterprise software company. It wants to be seen as a serious AI infrastructure player. And that is why its cloud numbers matter so much. In this quarter, Oracle's cloud segment brought in $8.9 billion. Expectations were around $8.8 billion. So again, a beat. But inside that number is an even more important figure. Cloud infrastructure revenue came in at $4.9 billion, ahead of estimates of $4.74 billion. Now on paper, that might not sound massive. But in the stock market, the quality of the beat matters more than the size of the beat. And cloud infrastructure is exactly where investors are looking right now. Why? Because this is the business most directly tied to AI demand. AI models need computing power. They need servers. They need storage. They need networking. They need massive data centers. And the companies that provide that infrastructure are in position to make enormous amounts of money if AI demand keeps accelerating. That is the race Oracle is trying to enter at full speed. So when cloud infrastructure revenue beats expectations, investors don't just see a good quarter. They see evidence that Oracle may actually be gaining traction in one of the most valuable markets in technology right now. And this is exactly why Oracle's story feels so different today compared to a few years ago. Back then, the company was mostly seen as a slower-moving software giant with a huge legacy business. But now Oracle is trying to reinvent itself as one of the companies helping power the AI economy from behind the scenes. And that is where the opportunity gets huge, but it is also where the danger begins. Because Oracle is not growing this business slowly, it is spending aggressively, extremely aggressively. The company's capital expenditures have exploded. In one quarter, capital expenditures jumped as much as 269% to $8.5 billion. And for the full year, Oracle expects capital expenditures of $50 billion. That number is massive. To understand why that matters, think about what capital expenditures actually mean. This is the money a company spends on long-term assets, not day-to-day expenses but heavy investments, buildings, servers, equipment, networking systems, power infrastructure, data centers. This is serious spending. The kind of spending that can transform a company if it works or crush investor confidence if it doesn't. And Oracle is pouring this money into AI infrastructure. That means the company is making a huge bet. Management is effectively saying that demand for AI computing, AI workloads, and data center capacity will be so large that it is worth spending tens of billions right now to prepare for it. That's the bullish case. Build early, build big, capture demand before everyone else does. But here, the fear. What if Oracle is spending too much too fast? What if the demand does not come through as quickly as expected? What if returns on these data centers take longer to show up? What if the market starts caring more about profitability than future promises? That is the tension at the heart of this story. Because Oracle is no longer playing safe. It is not acting like a defensive old tech company. It is acting like a company trying to force its way into the center of the AI revolution. And that kind of ambition can create huge upside, but it can also create serious risk. This is why investors have been nervous. Not because Oracle has no growth. It clearly does. Not because Oracle has no AI exposure. It clearly does. Investors are nervous because Oracle is spending like a company with something to prove, and in markets, that can either end in a breakout or a disaster. Then came another problem. Reports surfaced that Oracle and OpenAI had allegedly canceled a planned expansion of their Stargate data center project in Texas. And that report created immediate concern because it seemed to support the market's biggest fear. That Oracle's AI expansion story might be hitting a wall. If true, that would have been a major warning sign, because data center expansion is central to Oracle's AI strategy. Any hint of delays, cancellations, or pullbacks could suggest that demand is weaker than expected or that execution is getting messy. But Oracle pushed back hard against that report. The company said the media claims about the Abilene site were false and incorrect. Oracle said it is still working in lockstep with Crusoe. It said 2 buildings are already fully operational and the rest of the campus remains on track. It also said it has completed leasing for an additional 4.5 gigawatts to deliver on commitments to OpenAI. That response matters a lot, because Oracle knows that when you are asking investors to believe in a giant AI infrastructure strategy, credibility becomes everything. If investors lose confidence in the build-out, the entire story weakens. So Oracle had to step in fast and defend the narrative. Now whether the market fully trusts that response will depend on what happens next. Because in finance, what a company says matters, but what it delivers matters much more. And then there's another issue adding pressure to the story: layoffs. There have also been reports that Oracle is preparing to cut thousands of jobs. And the reason being discussed is that the company may be trying to help fund its enormous data center expansion by trimming other parts of the business. This creates a very mixed signal. On one side, investors might view layoffs as strategic. Maybe Oracle is simply shifting resources away from slower parts of the business and moving capital toward AI infrastructure, where future returns could be far bigger. If that is the case, then the layoffs are part of a transformation. Painful, yes, but intentional. But on the other side, layoffs can also be interpreted as a warning. They can suggest that the financial burden of these AI bets is becoming too heavy, and that Oracle is under more strain than it wants to admit. And that's why this stock is so fascinating right now. Almost every major headline around Oracle can be interpreted in two very different ways. The earnings beat looks bullish, but some investors see it as temporary relief. The guidance raise looks confident, but some investors see it as a risky promise. The spending surge looks visionary, but some investors see it as reckless. The layoffs look strategic, but some investors see stress. That's why Oracle is one of the most contested stories in the market right now, because both the bull case and the bear case sound believable. And to make all of this even bigger, Oracle is not alone. This is not just one company going wild on AI spending. This is an industry-wide war. Amazon, Google, Meta, and Microsoft are expected to spend a combined $650 billion in 2026 on capital expenditures, much of it tied to data centers and AI infrastructure. Just think about that for a moment. $650 billion. That tells you everything you need to know about how serious this race has become. AI is no longer just about chatbots, software features, or flashy demos. It is about hard infrastructure: land, power, chips, buildings, cooling systems, fiber, capacity. The companies that control the infrastructure may end up controlling a huge part of the value in the next era of tech. And Oracle wants a seat at that table. The opportunity is obvious. If Oracle can become a trusted supplier of cloud infrastructure and AI computing capacity, the upside could be enormous. That would justify the spending. That would justify the ambition. That would justify the raised guidance. But the challenge is also obvious. Oracle is competing against some of the richest and most powerful companies in the world. Microsoft, Amazon, Google, and Meta can spend aggressively and still have huge room for error. Oracle has less room to make mistakes. So Oracle does not just need demand, it needs execution. Fast execution, clean execution, relentless execution. That means investors need to watch a few things very closely in the coming quarters. First, cloud infrastructure growth has to stay strong. If Oracle keeps beating in this segment, confidence in the AI thesis gets stronger. Second, the spending has to show results. The market will want proof that all this capex is turning into real contracts, real utilization, and real revenue momentum. Third, margins matter. If Oracle's profitability starts getting crushed by all this investment, investors may become less patient very quickly. Fourth, project execution matters. Any future sign of delays, customer issues, cancellations, or problems around data centers could hit the stock hard. And fifth, management credibility now matters more than ever. Once you raise a long-term target to $90 billion, you are no longer just offering hope. You are making a public commitment, and the market will hold Oracle to that. So what's the final takeaway here? Oracle just delivered the kind of earnings report that could change sentiment. It beat expectations. It showed strength in cloud. It beat in cloud infrastructure. It raised its long-term revenue outlook. And it reminded Wall Street that this company is not standing still. But Oracle also reminded the market of something else. This company is making one of the boldest bets of its history. It is spending huge amounts of money to chase a future that is still being built in real time. That is what makes this story so important. This is no longer just about whether Oracle had a good quarter. It's about whether Oracle can reinvent itself as a major AI infrastructure force before the cost of trying becomes too heavy. If this works, Oracle could look like one of the smartest long-term bets in the market. A company that saw where the world was going, spent aggressively, and built the capacity to win. But if this fails, Oracle could become a warning story. A company that chased the AI boom, spent at full speed, and discovered too late that scale without returns can destroy investor confidence. And that is why Wall Street is watching every move. Because Oracle is no longer just reporting earnings. It is auditioning for a whole new identity. One quarter gave investors hope. The next few quarters will decide whether that hope turns into belief.